Okay, good afternoon. This is your weekly take on the market. Today's Friday, August 27th. Market's been closed for about 40 minutes here. And I'm your host. My name is Scott St. Clair. I'm Senior Product Coach here at MarketSmith. Here's the disclaimer. We're not licensed here at MarketSmith Investors Business Daily. So anything that we say should not be construed as a buy or sell recommendation. Take a moment to read this. Here are the gauges. The market is fine. Just, it might go down for 30 minutes, but not much more than that. Oops, sorry, I went too fast. The leadership is fine. It might be narrow, but there's stuff to own for sure. And hopefully you made a little progress in your portfolio. We'll talk about the overall markets, the indexes. But I thought this was interesting. The holding period for stocks is shrinking drastically, especially since, obviously the 30s and 40s. I don't know if that's a good indicator for, the times nowadays. Things are a lot faster. But what's happening is nobody wants to be a long-term investor. Everybody's got a short leash. Now, built into this, I'm sure, are the algos and the computers. And so they'll skew that a little bit. But it's really dramatic. And it tells me that it's like a poker game. I don't know if any of you play poker, but if you're playing poker and everyone at the table is playing super fast and loose, they're playing all kinds of hands, then the best strategy probably is to tighten up, play the opposite. If everybody's playing too tight, they're afraid, they don't want to play anything but premium hands, then you can play real aggressive and run them over. And so if all the world is, in a hurry to get in and out of stocks, then my thinking is I want to do the opposite. I want to hold them a little bit longer. And so I try to ignore the wiggles during the day. It's hard, especially if you sit in front of the screen, but there's a lot of noise during the day. And then at the end of the day, you just it's like the market didn't hardly, go anywhere. It just was up 0.5% or so. So I thought that was a pretty interesting tidbit. Then we'll get into the markets. Then we'll do the industry group. Then we'll do the stocks. And then we'll get into the quote of the week. Let me pause and go to MarketSmith Live. Here's a chart of the NASDAQ all-time highs. I'm going to beat this dead horse for a little bit, but the relative strength isn't all that great. It's only fly in the ointment, but it's acting fine. It's above all the moving averages. And so, I'm not saying you have to be fully invested, but if you're not invested hardly at all, then you're just guessing, right? You're trying to anticipate that it's going to go down. And I've been there before. Somehow the market knows and just doesn't go down. So you should be in go mode, buy mode. You should have some exposure. You don't have to be 100%. The nice thing is, I've said this before, the stocks that we have, the leadership, if you get a hold of some good ones, you don't have to be 100% invested to beat the market, which is great because some, if you have cash accounts, IRAs, et cetera, like I do, they can't ever go on margin. So there's a lot of quality out there, and when they move pretty good. The S&P, another new high. I noticed the Russell, the IWN had a really good day today. I think it was up almost 3%. The volume was a little bit bigger, and I'm using the ETF because our Russell is delayed. And then emerging markets, where all the carnage is that the market's overlooked. It's not that bad, really. What are you're 11.5% off of 52-week highs. It's just kind of a normal correction in emerging markets. China's really bad, right? And the Babas and the Tencents of the world and Pinduoduo, they've gotten torched. This is a classic bear market. I talked about last time how it stays below this moving average. If this was an index though, this would be what would we call that right there? That would be, it's really hard to see. So I think that'd be 1, 2. Oh no, that only might be day 3, a day 3 follow through day. But it was up a lot, right? 11%. That's a lot. But if you were watching this and this was an index, you'd be looking for some type of follow through day. But the stocks aren't setting up, so I'm not watching that, which is why I didn't even realize it was day 3, is day 4. I'll worry about it when the stocks start to set up a little better. Let's go to the industry groups. Energy coal is number 1. I never would have guessed that if I didn't know it. Our retail is 2, steel is 3. So not your typical can slim growth areas. Finance, consumer loans, commercial services, healthcare. I have to admit, I don't think I could name a stock in that group fairly quickly. If you told me some, I might know. You have to kind of go down the food chain a little bit. Security has done all right. Sentinel had a really good week. CrowdStrike is getting added to an index. It had a good week. I always like computer software security group. I think that's a growthy group. So the industry groups are, they're not that exciting. They're not, I don't think I'd own anything in coal. In fact, before this, I was, before I got on this call with you guys, I was looking at the group. Like, I was like, what am I missing? What am I not owning there? So if you open up this panel over here, you can see the stocks that are near new highs. Peabody made a new high today. So did Arch, so did Alliance. You can see the top RS and EPS stocks right here. METC, can't say I've ever heard of that. But if you want, if you go to stocks and group and you click this button, show all component data, then you can review this group. And this list is sorted based on EPS and relative strength. So CEIX 65 and 98 is the largest number. Now METC matches that, so there's a tie. I think the tiebreaker is volume. Yes, the tiebreaker is liquidity. So we try to create this list in some kind of order in case it's super deep. You're really going to get the best quality at or near the top. And you could just go through this list. You could double click CEIX, and then you could just hit the space bar and see if there's anything setting up or of interest to you. They're all acting super good. Look at RS 99. They are coming off of, beaten down. Let's go to the monthly. Wow. That surprised me even more than I expected. So that's probably why I'm not in any of those names. The 3 stocks, let's start with FOUR. FOUR is the ticker. Nice IPO run, hard to be in. It was real sloppy, a lot of back and forth, but has really good sponsorship, which is what interests me in this stock. Columbia, Lord Abbott, Invesco. So I've always wondered, when they were losing money, this company was losing money and the revenues weren't all that exciting. 11, 4, negative 21. It's probably why I had a hard time holding this stock. I don't think I ever made any real money in it. But the sponsorship always intrigued me. And now you have a really good quarter, triple digit earnings and sales. And you've got, this is your first base. I think that base failed. This is really, I think, probably your first base. It's not very good so far. It's a sloppy base. But I was trying to find stocks that are in bases that are setting up, because if the market's good, there just aren't a lot of stocks doing that unless there's some type of rotation in the groups. So this is stock that I love this group, Finance Payment. I've done really well in PayPal and not as well in Square as some people have, but DLO, I believe, is in this group. Yeah. So I have a soft spot in my heart for this group. So anytime I see something setting up in this area, I'm intrigued by it. So just trying to find something that had a base. This stock, Task, gosh, what do they do? So you just get this huge move right here. out of this. It's not an IPO base, but it's just, it's first base right here. I don't own this one, unfortunately. It was in the breaking out today, so I can't blame MarketSmith that I don't own it. It was there for me. Just didn't know it well enough and know enough about it. But man, I want to really understand this company because this kind of power is really unusual. And that way, if we fast forward 6 months from now, or it either comes back to the moving average, or ideally it builds a base or something like that, then I'll be ready. I'll kind of have an idea about it. But this stock's really powerful. No sponsorship as far as the mutual fund index just yet. To go down here, Fidelity Blue Chip Growth, which is a fund that I follow, I've flagged, has a tiny position. So there's a little bit, but I just thought this power is very intriguing to me. What else did I have in mind? I forgot to write the 3 down that I was thinking of. Let's go to Deere. So Deere is setting up in this cup with handle. This is the downside to trying to buy them early. I bought Deere somewhere in here and then got shaken out in the handle. I might have lost a little bit, made a little bit. That's not, I can't remember. I just, knew it just kept going down and down every day. And I knew the earnings were coming out, and that wouldn't be that much of a factor for me. I tend to hold through earnings if I like the name. I take the good with the bad. But I just thought that the handle was too steep and the volume was, just tracking higher in the handle, which bothered me. So I got out. But now it seems to righted itself, and you've got a proper pivot at what's that, 388 and change. So that's a really big name that's setting up. It's big and liquid, and it might be too slow for some of you, even for me. I prefer, the fastest horses, but gosh, this was a really tremendous move in Deere, which is intriguing to me. And look how, I'm never going to say easy to hold, because they're never easy in my opinion, but it was a lot easier to hold than something else. Look how it just tight, respects the moving average the whole way up, never does anything really wrong. That's what I'm hoping that if it does break out, I can catch that second leg up. All right, let's go to the quote of the week. It's from Aaron Brown. He's former risk manager at AQR Capital. I can't remember where he said this. It had to have been on a podcast or a YouTube video or something. But I thought it was super intriguing when I heard him say it, because it really, it just startled me and hit me like a ton of bricks. Wow, I think he's right. The more you pay for stocks, the safer they are. And for the most part, the higher your expected return. I would bet that he studied this too, with his background in math and statistics. So somebody emailed me because I did a seminar for the IBD Boston meetup, and he was really intrigued by this statement. He's just had a hard time wrapping his head around it. How can this be true? But think about it. I remember paying $100 for Google in 2005, and I probably paid $400 for it in 2007. And I remember paying $1,200 for it a couple years ago, and now it's what, 2000 and change. And so the higher they go, the better institutional quality they have, the more sponsorship, and there's a reason that they're going higher. So you should never be afraid of stocks that are going up. It should be a sign that you're in the right stuff, or you're trafficking in the right fishing pond, so to speak. Apple is a great example. It's just got, for a while, Apple was a dog. It was just not a good company. There's not a good stock. Go back and look at the historical price action. And then something changed in 04. They got this new product, and it's just made new high after new high after new high after new high. Of course, there are going to be corrections along the way, It's not going to be straight up, but every dollar higher in Apple has made it a better, safer, and higher expected return. And think about the opposite way. My favorite example is Enron, because I bought Enron coming out of a base. I don't remember what year it was the last base that stock ever built. And I got stopped out for a loss. And I think I bought it around 80 and sold it like 70 something. And then it went 70 and 60 and 50 and 40 and it just got more and more risky, right? Even though the price was lower. At 10, it was uber risky. It was tenfold more risky than it was at 70, because at 10, there was the risk they were going to go bankrupt. The stock's going to go to zero. And that's what happened. It went from 10 to 5 to 0. So the more you pay, that's when you want to buy stocks on the way up. And you don't want to be afraid of stocks that seem too high. The stocks that seem too high always seem to go higher. It's writing from Bill's book, and it just happens over and over and over. So I sometimes catch myself, I want to buy XYZ, the stock's 70, and I'll put an order in. I'd really like it to undercut below this and buy a little shakeout, and I'll put an order in at 65 or something. And invariably, I never get it. And if I do get it, the stock goes a lot lower. It tends to go down to like 60 or something. And so it's like I should pay 70 because it's probably on its way to 100, or wait for it to do that, because if it goes to 65 and then 60, I don't want it anymore. So maybe go to 65, then back on its way to 70, I can buy it again. That's a better, more risk averse buy. And you get, you're not looking for the best price. You're looking for the right price. The best price in every stock obviously would be the low, but that's not the right price. Sometimes they can stay down at those prices for a long, long, long time. And so you're looking for the right price as the stock is starting to show some momentum. Things are changing in the stock's favor. Oh, okay. I was going to use 2 of his quotes, but I'm going to save one of them. So here's our contact information. Reach us at marcusmith.com, 800-831-2525. Thanks a lot, guys. No take on the market next week because twofold. We'll do our Thursday event for the Stay in Step. And we don't usually do a take on the market the very next day because there's a lot of crossover. Some of the things that I would have given you today, I'll talk about on this coming Thursday. And then it's long weekend. So I will be working a short day that day. Have a great weekend, everybody. We'll talk to you soon. Thank you.